Hey, what's up, Facebook world, YouTube world, Instagram world, and everybody else out there? Welcome to the Ask Me Anything BYOB happy hour. So grab your drink, get your questions ready, get them in the chat box. We are here to answer all of your questions and talk a little bit about infinite banking, becoming your own banker, and what that means for you. So with that said, I'll play this quick little intro video. We'll be right back to do an introduction and get this show on the road. All right, welcome, guys. Stephen Nagy here, checking in from the BYOB Worldwide Headquarters in Southeast Florida, the Hope Hideout. We are live and direct. We are ramped up and ready to go for the 3-day BYOB Blueprint virtual event. Starts tomorrow morning, 10 a.m. Eastern. Hopefully you got your ticket. If not, let me know. I'll put the link over in the chat box if you still need to pick up a ticket. It includes the recordings, all the bonus workshops. Jason Sipple's ready to go. Brian Faust is ready to go. Tess and Linus are ready to go. But we're bringing you the heat for 3 days straight. Starts tomorrow morning. Looking forward to it. But right now is Ask Me Anything. So we are here to answer any questions you have around infinite banking, becoming your own banker, alternative investing, real estate, whatever you got, throw it out to us. We'll do some introductions and start answering those questions. So get them over in the chat box. Brian Faust, what's going on, dude?
Nice weather today here in North Idaho so that it can rain for the next 10 days, which is going to suck. But we need it up here. It's pretty dry. But Brian Fouch here, everybody, infinite banking practitioner and also annuity person as well. So if you guys have any questions around qualified retirement funds, risk of those funds, how to get those funds into a safer, more guaranteed environment, put those questions in the chat box as well, because we do annuities as well, which can help you kind of lock in that guaranteed income. And so just put those in there. But yeah, with that, I'll pass it over to Ms. Tess.
Hi, I'm Tess Hulick. I was going to claim to be the Michigan Center, but there are other agents here, so I won't grab that title. Stephen just disappeared, so I can't give him a hard time about it. Like I said, anything you guys want to know, please put it in the chat box. We're here to help. And now I'll go down to Linus from I'll Let Him Tell Us.
Hey, everyone. Linus Nolt here from Hopkinsville, Kentucky. We've had our 10 days of rain, and it's finally the sun's finally shining most of today, so that's welcome. Even though I think probably 2 weeks ago on the AMA, I said, hey, everybody around here is dry. Farmers are complaining their crops are going to stop growing. So there's always cycles. Today here, I'm happy to help answer any questions I can. I love infinite banking, setting up policies. Specifically an expert kind of on the underwriting side, getting people qualified because it is still life insurance. And so it does require you to get qualified, to be qualified health-wise and financially and more. Jason, what's going on?
Yeah, thank you, Linus from Hopkinsville, Kentucky. Always happy to be here. Always happy to answer your questions. So get them in the chat. Blessed to be part of this team. Every week we come in and we answer basically the same questions, but they're always unique. We're always learning new things and able to share new takeaways. Industry is always changing, so we're always staying up on what the latest things and trends and patterns that we see and how we can serve you so your money can work a little bit harder for you than it has been. So get those questions in.
I don't currently see any questions just yet. So as well said, go ahead and get those.
We're done. Good job today, everybody.
Yep.
We had a good Ask Me Anything. We'll see you next week.
Join us tomorrow for the 3-day blueprint.
Yeah. Now we got some questions that came in here during one of our prior presentations. So I'm going to go ahead and go through one of those, and then we'll get into some of the other questions. Anthony, appreciate you putting that question in. So this came from James here in our prior live stream today. And it says, is the policy built on the death benefit or the monthly yearly premium?
So chicken and the egg a little bit, but most likely, I would say 99.99% of the time that we are specially engineering, or I'll at least speak for myself, that I'm specially engineering things. your death benefit is just a product of what you are putting into your specially engineered policy. Like, how much are you depositing on a monthly or annual basis? Are you overfunding it? And then whatever that death benefit is based on design and what your outcomes are is just what it is. Or if you say, hey, I need this much coverage because I have to protect my partners, I want to make sure all my liabilities are covered for when that day does come, then we'll go the other way and we'll tell you how much you need to make that happen. So, but typically it's going to be the first way.
Go
ahead.
I was just going to say, like, even today on Wealth Wednesday, Chris was mentioning that Dave Ramsey was right about a certain thing. Some whole life policies are written specifically for the death benefit, which is why there's no cash value in the beginning. And we don't write them with the goal of the death benefit. It happens as a result of, like Jason said, the specially designing.
Yeah. And the way I kind of explain that, the answer to that one is that the death benefit is a result of how you fund the policy, but it's not the focus. Yeah. The focus of how you fund the policy is to build the cash value, which is a component of the death benefit, is part of the death benefit. So it's kind of reverse. Most people, when you go to an insurance agent, they're going to say, I want $1 million of death benefit. How much is it going to cost? Well, that's what we're going to give you. It's going to be a pure death benefit, and that's it. The infinite banking, we look at how do we want to fund it, what do we want to put into it, and how are we going to use this thing? Oh, by the way, as a result of all these factors, here's the death benefit. So it's kind of reverse a little bit.
Which is why we always hear that word, reverse engineered.
Yep. Another question I got here is a pretty simple one, is from Jim. It says, I am retired. Will I qualify for a policy with no earned income?
That came up on Wednesday.
It did.
Yes,
I wanted to address it here because
we got an underwriting expert with us today and a few people that know a little bit about something to do with insurance. So I'll let one of them take it.
I said potentially. What other income do you have? I would assume you have some income from maybe Social Security, maybe retirement accounts, maybe you've got VA benefits. Like, any income stream qualifies to use to justify. So unless you're completely without any income, you should be able to qualify from a financial standpoint. If you have any net worth, a couple $100,000 at least, the net worth can also help qualify. And if you have no income, they can potentially justify the premiums that you're wanting to put in based on, hey, you're putting this percentage of your net worth into whole life over a period of time, and then premiums stop. Like, there's different ways to come into that to solve the issue if you don't have income, but still, ideally you have fair income to be able to justify funding a policy.
Yep. All right, so Anthony's got a question here. Have any of you heard of a California 575E unincorporated nonprofit association? Now, I actually have heard of this.
I haven't.
From one person. You guys want to guess what area this is going into?
Yes, it is sovereign citizen territory.
Yes. So I don't, beyond that, I stay away from it. Because whenever it comes to the sovereign citizen area, I stay as far away as I can. I literally had a client of one of my other businesses who's just a paying member. And I tried to get a hold of him one time and couldn't do it. He was in jail again for the 4th time.
Oh, no.
Yeah. And then he gets out and then he's telling me all these crazy stories about what he's doing. And then he's in jail again. So I stay away from that whole arena. But yeah, Anthony, if you learn more about it, feel free to share. But yeah, anyways.
It's always good to be curious. It's always good to go down rabbit holes and really decide for yourself. I mean, I'll encourage everybody to think for yourself. It's one of the things I've been most impressed with working with these large mutuals is they're like, hey, we don't outsource our thinking. And that means when they're looking at risk, when they're looking at strategies, when they're looking at different things, it's really nice to know that they have experts in each of those areas that are identifying risks and what it is and all those things. And so when you see things that are out of the norm and you're curious about it, by all means, learn more about it. But like Brian said, try to understand the trade-offs and try to understand, is that really leading you down that direction? Yes. that you wear a cool hat
Hey
like
guys,
Steven
I'm a
wears.
sovereign citizen. That's illegitimate, I tell you. Okay.
I see that tinfoil hat.
I like that hat. And there
Tinfoil
it
hat.
disappears on us. It must have caused too much friction. It looked metal.
I think he got that in Key West. I think he
Did
got
he?
that one in Key West. That would be my guess.
I think this might be for you, Jason. Why is this not working? There we go. All right. Where are you located?
Oh, in the city beautiful Orlando. But I do like Chattanooga. I've got a tattoo there once. I've done 2 Ironmans there and supported one. It's a fun place to be. So
There you go.
Yeah. We
I
have a
wouldn't
couple of
have
team members that live in that area, but no location that you would be able to visit really. Where we're entirely remote, so we are all across the country. We're able to help all of you guys all across the country, and it's kind of the nature of society nowadays is that everything is from home and remote, and we connect by video calls and all that. But yeah, we try to do a fair amount of in-person events as well.
Yes, Anthony says, I've never heard of Sovereign Citizens. I heard of it through Mike Adams, the health ranger. I don't know him. Just go to chat or Google and just put in Sovereign Citizens and you will be busy for a while. It is a rabbit hole. There's a lot of stuff behind it, and I have never met one person yet that has made it work. Basically, you try to separate yourself and not be part of the government system and taxes. But anyways, it's the whole ball of wax there, or ball of yarn, or whatever you want to call it.
Yeah.
So Kathy's got a question. She says, team, we have received a healthy inheritance. Thoughts on policy or potential plans? Our goals: build retirement income fast, buy a house, long-term care, and create a legacy. We have our first policy, almost 1 year old, and would love to have more. So deferred annuity, another policy, etc. We have invested with Kevin Shortell and to learn the system. Trust is ready to fund as well. So obviously, Kathy, we can answer the question here. I know your situation intimately. So just let's grab a time for you and I to chat about it. I know we've already had a little bit, but let's kind of keep that ball rolling. But yeah, we can dive into a lot of the stuff. But there's a lot of options you have here. And so the approach that we'll talk through is what are you trying to accomplish first, and put that in place first, and then layer other things on top of that to keep going, because you got a lot of things that you can do and a lot of things going on. But anyone else want to kind of respond to this one?
I think it's a great common question, right? Like, first, congratulations, healthy inheritance. Where does that money go first? Is the question you're starting to ask, because you're seeing that you're a year into a plan. You've been around the campfire. You understand that there's a lot of different ways to put your money to work for you. And you also understand that putting it in a foundational asset, like specially engineered whole life or just whole life, is going to be an and both asset for you. And I'm saying this not for you, Kathleen, because of your situation is pretty common and not that unique when people start asking, what do I do first? And when I think about what do I do first, I always think, well, first, can I make the foundation I have stronger? Can I increase the foundation before I go put that money to work, so I have my money making me money? And that way, at some point, I can stop making money and just have my money make me money. So talk to Brian about that. He'll help.
I'll give you a scenario that I'm working with another client on right now. And this is an annuity. And so the dollar amount, the put in annuity, it's a larger amount, 6 figures, but I won't get into the amount. We looked at an immediate income annuity, and it was $1,600, $1,700 per month, guaranteed for the rest of their life. Keep in mind, husband is 60 or 61, can't remember. Wife is 57 or 56, so that makes a big difference. Then, and I'm going to talk to them hopefully today, and Tess, you know who I'm talking about. Now we're going to do a deferred annuity potentially. So we defer it for 5 years, then it creates income. The instant income, like immediate income today, that provided $1,600. If they defer it for 5 years, anybody want to guess on the amount of income it turns into when you defer it for 5 years and then take income?
$3,400.
$2,800.
Over $4,000.
What the heck?
Yeah, it's about $4,500 by deferring the income for 5 years.
Well, let's talk about that for a second. Yeah, let's talk about why it triples. Like what is the carrier, right, your partner, doing with that money when you give them that money?
So for a deferred annuity, they're taking that money and they're putting it to work.
Oh, yeah.
But they're taking
For
the
everything.
gains and they're putting it back into your bucket.
Yeah.
But what they're doing also is you're locking in the guaranteed rate at 5 years as well. So you're locking in the rate today of how it's going to grow and how much it's going to give you down the road. Deferred incomes deferred annuities are amazing.
Yeah.
And so just by waiting 5 years, it's like Social Security. The longer you wait, the more you're going to get. But the wife will be in her early 60s and they'll have a $4,500 income. He's already got another guaranteed income source. When we go through the math on this, his fixed expenses are going to be more than covered by their guaranteed income for life. And it applies to both the wife and the husband. Whoever lives longer will get it all. So there's options there. So with what you're doing, Kathy, like there could be the guaranteed bucket for income, then there can be the actual investment bucket or build wealth bucket, which can be infinite banking, et cetera, et cetera. So there's a lot of things we can discuss and a lot of fun options.
And
So-
yes, we're glad that you have the inheritance, but we're also sorry for your loss.
So yeah, so so let me know, Kathy, when you can talk and we'll go through that. But there's some good options. And right now is a really prime time because rates are high, but they just dropped actually yesterday a little bit on the annuity side. They changed daily. So, all right. So Joe's got a good question here. It says, can you do a dump in on a policy at any time you choose? This question has been coming up a lot recently.
If the policy was designed for it.
Yes. Yes, there is some structure inside here. Kind of the way I've explained that one is the bucket mentality. Like if you have a bucket, think of like the bucket as the policy, and every time you put in a PUA or a dump in, you're putting a little bit of water in there, right? But you've got to design the bucket to accept that water and how much water and all that kind of stuff. But so Joe, I don't know, have you talked to any of our mentors before? Because if so, that would be a good reason to schedule a call with one of our mentors to go through some of those questions, by the way. Let's see here.
If he has a policy now already, just do this. Get in touch with your implementation agent on our team, or just in touch with your life insurance carrier themselves, and just ask them the question, hey, can my policy accept any extra premium, a dump in, a PUA premium? They'll know what you're asking. Whether it can accept any extra right now without becoming a MEC. That's the important part. And they'll be able to answer that question. Now, that's if you have a policy currently. If you're exploring a policy now, with a money mentor, ask the question, hey, are you designing this for any extra potentially in the future? Could we do that? Or, your money mentor is going to come back, okay, why are you thinking you got more that you might put in, and let's explore what you would do with that, see what makes sense.
Yeah. I don't show that Joe has a mentor assigned to him yet.
Okay.
A good idea to get one. All right. So good question from Elizabeth is asking, when I get a lump sum, what happens when I come to you to find out what to do with it? Good question.
We talk about it.
Yeah. What are your goals? What do you currently have?
Yeah, and Elizabeth, I'll put a link in here in a moment in the chat box where you can schedule a call with one of us, and that's called a strategy call. And what we're going to go through is just your situation. We're going to ask you a lot of questions. You're going to ask us a lot of questions. We're going to start to figure that stuff out because there is no immediate answer to that until we understand what you're trying to accomplish. Because really, what you should do with it is the best thing to accomplish your goals.
And here's a different way to, and thank you, Brian, that was really good. Here's a different way to kind of talk about this. What you won't get is you're not going to get a bunch of quotes for ideas. And, I had a couple call in on the 800 number today, and they're like, yeah, we want a quote for my son, for this, for that. We want to see what this is going to be, how this is going to work better. And it was very much, it wasn't identifying what their goal was. Where do they want to go? What were the trade-offs going to be of being 68 years old and trying to put $200,000 a year into or $200,000 initially into a policy, right? With a much smaller annual amount. So it's really going to be about understanding where you're at today, what you're trying to accomplish. And then we're going to have you walk us through how you would solve that problem. And don't be scared. You just pretend you know what you're doing. We're going to ask you to tell us how you would solve the thing that you're trying to solve, the problem or opportunity. And then we're going to build it for you. We're going to show you, and you're going to see what that plan will look like before you ever execute, before you ever go into the application process. And you go, hey, Mr. and Mrs. Insurance Company, would you take me, Elizabeth, as your partner? And that's how our team guides you through that process of what happens every step of the way. And all you need to do is understand where you're at financially, what you're trying to accomplish, and be willing to have a conversation with someone that's going to guide you on how you can get that done.
And if we haven't said it, the strategy calls are no cost and there's no obligation to move
You don't
forward.
charge?
No.
Oh,
Do you? Oh, I didn't know you were charging.
Nope, I've gotten hats, I've gotten honey, I've gotten cards. I've never received money tests. I say that on almost every call now.
That's what I was going to say. What gift did you get in the mail?
I would like anyone who wants to send me more honey. That was my favorite gift so far. So
did I tell you my honey story? We were in Salt Lake City for one of the PMC events, and I brought some honey back for my mom. I forgot that you can't take it through the airport. He let me take it. It was a huge container. He let me take it. He goes, I know what you did. Go for it. Give it to your mom.
It's not liquid.
Well, they actually will take honey at the airport.
Oh, yeah. All right, we got another question that came in on the other live stream. I want to cover this one here. So this is from Deborah. She's asking here, says, do financial advisors handle or advise on trusts instead of wills? Because I was in a situation that taught me regular wills cause family problems. She says at law, but I think what she means, at that time. Anybody have an experience or want to explain that?
It's not really a financial advisor thing. It's going to be more of a legal professional, like a
estate planning attorney.
Yeah, an estate planning attorney.
Yeah. So my experience on this one, so it's not a trust instead of a will. It's a trust with a will inside of it. Well, that's how they're built.
Will is going to direct like what go up, but a will won't avoid like probate and all the stuff that happens with the estate. So a trust is what's gonna help you with that and have the assets in a place that'll skip probate and make sure they're not taxed and all that crazy stuff. So you definitely want both. And it's not a financial advisor. You're going to want to work with a estate planning attorney. So if you email us, we can connect you, who I personally use and has helped hundreds of our students and clients over the last several years too, in a company called Corporate Capital. So if you want to email us, we can connect you with them.
Yeah. Because the problem there is like a will becomes public when it goes through probate, and it can be contested, it can be sued, it can be, it can be all sorts of crazy stuff. Family members can say it's not legit, all that kind of stuff. But through a trust, it avoids the probate side of things. It privatizes the will as well. And then oftentimes what the trust attorney will do is you can set up a video will. So it's a will, it's the will, but it's the person that it's their will. It's them reading the will to the camera to show that they are competent, that they're in a good state of mind, not impaired, all the kind of stuff. So you can make those things pretty robust.
When you layer and when you layer in the trust, the reason you've heard what you've heard, and those explain really well, but the reason you've heard what you've heard is exactly that. Like a will can be contested. A will is not inside some legal entity that's going to avoid probate. And so then having it, like Brian said, inside a trust that has your wishes, that your trustee can go and look and say, hey, this is what you wanted to have happened. And it's very clearly stated here. And that's how you pass on the systems and processes to the next generation. Or you simply make sure that what you've left behind is appropriately handled. So,
yep. There you go. All right. Anthony's got a good question I like. It says, can a policy be designed so that a dump-in, which, by the way, for everybody listening, is a lump sum paid up addition done at the very beginning, usually in the first year. But he's asking, can it be designed so that dump-in can be delayed until after the first year?
Yes.
Certain companies, by the way, not every company can do this. But I did this for somebody here recently. They said, hey, I want to do this dump-in, but I want to do it after year one for various reasons. So Linda, let me know if this is correct. So I built it with the dump-in in year one, and then created the whole thing with that company, and then added to year two, and then removed it from year one. And it illustrated just fine. That's how I did it. And the ratio in year one was normal as far as how much cash value was available. But I removed it from the one section, but I had it still put in on the LPUA side for 5 years too, by the way. And had about an 85 to almost 90% to cash value in year one. And then, but yeah, the answer is, Anthony, yes, you can. Let's see here. All right. Cole Olds is asking, why does the government tax inheritance when they just print money for whatever they want anyways?
Good question.
And is that a military outfit I see?
Yeah. Now there are some things they don't tax. There's a certain amount, like the kind of, what's it called?
Base.
There's I think, is it state specific? The estate tax? I thought it was state
Well,
specific.
federally it's not, but it is state specific on the state side too.
Yeah. Okay. So I thought.
Mhm. But yeah, there is a state tax exemption
Up to certain amounts. It depends on the size of the estate. And it depends on the type of inheritance too, by the way.
Yeah.
Because, hey, guess what? Death benefit inheritance is tax-free and guaranteed. Not really an inheritance per se, but it kind of is. But it just depends on the type. And I'm not a tax professional, but it just depends on how you have everything set up as well. That's why estate planning is so powerful, because if there's going to be huge tax issues, an estate planner can help you mitigate those things. Oh, Robin Old's not me. I'm a quarter of the man he was. Yeah. It'd have to be situation specific. But the second part of your thing about printing money, yeah, it's insane. The government is like this: do what we say, not what we do. It's exactly how I feel the government is. Because think of the government like a business. If you ran your business like the government runs their business, you'd be out of business decades ago.
Yeah.
You wouldn't be in business anymore. But since they can print money, they're still in business. Worst business ever. Worst ever.
We're the best, one or the other.
Yeah, that's funny though. I'll put the link in the chat box here in just a second for this one. All right.
So I just refreshed myself a little bit on when death benefit or part of death benefit might be taxable. And here's one I just learned. Employer provided group term insurance. Sounds like it's often going to be taxable over $50,000. But otherwise, it's pretty basic. Death benefit is always tax-free, income tax-free, unless it wasn't all paid out up front in a lump sum. If it was kept back and let accrue at interest, that interest obviously is going to be taxable. And installment payouts are usually going to grow in the background for the parts that haven't been paid out yet. So that growth is also taxable because it's no longer in a policy. It's just sitting in an account for you.
Yeah.
And then if a life insurance policy was sold or transferred to someone other than the original owner, a portion of that death benefit may also be taxable. I'd read up more on that. I believe it's actually more on if that policy was transferred outside of family, immediate family. So I'm not real sure on that one. And again, I should mention this at first. We're not tax professionals here. We're not certified and authorized to provide tax advice. This is just some of the stuff I was reading off of Google.
Yep. Absolutely. Yeah.
Uncle Google is pretty smart though, usually.
Yeah. That's why the trust structure is so important too, because how you structure a trust to receive funds, hold those funds, and disperse the funds can have tax consequences that otherwise wouldn't be there with a pure death benefit payout. So that's why talking to that trust attorney and explaining what we're doing is very important. I have clients right now that have trusts that are paying them monies from some sort of a benefit, but there's tax issues now too. So it's got to keep that in mind. And I like this comment from Anthony because the government doesn't print money. The Federal Reserve does.
Yeah.
It's not federal and it's not a reserve. I love that. Yeah. But where does money get printed? Federal Reserve is the first one. What's the second cause of money printing?
Banks, loans and banks, Brian.
Banks are the second leading cause of inflation.
For $500, send it here.
Yep. There we go.
Little Jeopardy.
Fractional reserve lending.
Yep. Should be illegal, but for some reason, Lord knows why. Hey, look, Jeffrey says, what's up, BYOB fam? Soon be the policy owner here. Shout out to Jason, my money mentor.
Congratulations.
What's up, Jeff? Jeff in Jersey, my old stomping ground. Super excited for you. This is someone who's going to go far in this community because he's building that foundation. he's already creating passive income for himself and the way he thinks. So congrats, Jeff. Awesome to have you here.
Yep, right there. Fractional reserve banking. Absolutely. All right. Reagan Smash is asking, do you know anything about 401a? Do you help set them up for a business or know who could help one set up? Yes and no, because a 401a is like a 401k, but it's an employer-sponsored retirement plan, but it's typically for government agencies, nonprofits, and then educational. Is it educational?
Yeah.
Yeah, educational and nonprofit, and then government. So if you're a nonprofit or an educational institution, yeah. If you're not, then it's just going to be a solo 401k in most cases, depending on the size of your business. Because I've had solo 401ks, but I had an LLC. But to set those up, you just go to a 401k provider or custodian, they're called, and they'll just set it up for you based upon your entity and all that kind of stuff. Because you have to be a financial advisor group to set those up, because they are under the purview of the IRS and their codes, and they're a qualified plan. Yeah. But my question to you would be, why are you wanting to do a 401a through your business? What is that accomplishing for you? Because if I was to go back to when I had a solo 401a, guess what I would have done instead? A 501k. Which, by the way, a 501k, jokingly, is actually the guy who created the 401k. I think his name's Ted. The guy that created it never used the 401k. Ted Bennett. He had a 501k. That's what he called it. It was a whole life insurance policy, cash value focused. So the gentleman that created the 401k or A or whatever you want to call it actually uses life insurance instead of that.
It kind of struck me as funny that people have all these other names for it, because whole life has been dragged through the mud so much, right? By Daddy Dave and others, Susie and others, that just say it's so bad. I have another guy, Brian, and everybody here, that he works with very successful entrepreneurs with taxes. Like, he understands all of the code to where he ends up saving them usually hundreds of thousands of dollars annually. And then he tells them, congratulations, you just qualified for the Rich Man Roth. Guess what the Rich Man Roth is? A specially engineered whole life. He just takes extra money, insures it into the policies, and away they go. Now they have guaranteed growth, and they have that alternative asset that is always guaranteed, and that Ernst Young says you should have between 10 and 30% of all your assets in whole life. So go figure.
The Rich Man
Roth.
Roth IRA.
Okay.
Yeah,
that makes sense. Rich Man Roth.
Yep, I love it.
That's just like the 501k. So again, people have all these names because they're afraid to say whole life, was the kind of the joke I was making. Like they don't want to tell you it's whole life.
Yep. So Kathleen's asking, can 401k funds be transferred into an annuity? Yes, they can, as long as they're qualified to roll over. So what I mean by that is, the answer is yes, because an annuity is considered a qualified account, and so is a 401k, called QRAs, qualified retirement accounts. But it has to be it has to be available to roll over, which means typically you cannot be employed with the same employer that has the 401k in most cases. And then it doesn't have to, then if you're rolling it over, the 59.5 rule doesn't apply, because it's a rollover, not taking income. So keep that in mind. But yeah, you can. And then when you do that and roll it to an annuity, then the type of annuity also matters, because what you want that to accomplish. Like, as an example, I'll give you a case study right now for a client of mine. She has a 401k, not doing very well, been pretty flat, and it's an old one, not a huge amount, but it's a sizable amount. So we're going to put it into a MYGA, which is a multi-year guaranteed annuity for 5 years, and it's going to grow for 5 years at a guaranteed rate that's beating what she's doing right now with it. At the end of the 5 years, she can choose to keep doing that, roll it again, another 5 years, or she can put it into another QRA. She could go back to a Roth or a 401k, I believe. And then eventually down the road, she's going to turn it into income. So with an annuity, an income annuity. So there is some versatility inside of those things. And you can also have some slight liquidity in a MYGA as well.
10%.
10% per year. Yep. The 59.5 rule, though, applies if the funds came from a 401k. So you have to be careful there. But yeah, Kathleen, we can talk about that on our next call. But yeah, and by the way, the reason why she's doing it, because she's scared of the markets, doesn't want to be in the markets, is seeing volatility, is looking at right now what's going on. She goes, I feel like this is all at risk. So she's removing risk by going to an annuity that's guaranteed. So Reagan Smash asks, for life insurance and annuities to get my business income down. Okay, so this is in reference to the prior question about the 401a. So for life insurance and annuities to get my business income down. So what's the question here? So you're asking about the 401a originally, and now we're saying for life insurance and annuities to get my business down.
Yeah, you were asking him why he would want the 401a or why he's looking at.
Oh, well, the 401a doesn't life insurance or annuities though. So if you're trying to get your business income down, which is assuming is a tax strategy, the qualified accounts are what can do that because you're funding them with post-tax dollars. Life insurance is almost always going to be post-tax because it grows tax-free.
Yeah, or
tax deferred.
Yeah, or again, not giving financial advice, tax advice, or any of those things. We're just saying what we've seen and what we've talked about in our thousands and thousands of conversations. Or congratulations, first of all, right, that you're making enough that that's the big concern. But next would be looking at talking to a tax strategist to have assets that you can use as depreciating assets and cost segregation and a bunch of other different ways to utilize the 7,700 page and growing tax guide just to understand what the wealthiest are doing. So that's another way to handle that conversation. But to Brian's point, life insurance is a great way to take money you have now, because my CPA yelled at me, Jason, why are you putting so much into the policies? That is not tax deferred. You are going to have to pay taxes on that money. I was like, yes, but that money will grow for the rest of my life. I can use it for the things I'm solving now. And it set me up for exactly where I want to be in year 10 and beyond. Right. So I started with the end in mind, and I was fine paying extra taxes to start and then move forward from there. Because I mean, I put almost 2/3 of what I made in a year into a policy, into a series of policies. So, but I did it because I've tried the 401k plan. I've tried maxing it out. I used to go see Schwab every year, and they would always ask me, Jason, how do you feel about taking on more risk? I'm like, that's stupid. I don't gamble. I'm not taking on more risk. And I told him I wanted to retire in my 50s. I'm 51 now. This is back in my 30s. I was maxing it out every year. And the next question they always ask me, well, how do you feel about working an extra 17 years? I was like, well, that's really stupid. I said I want to retire at 50, not 72. So, and there was never, I would just leave mad. And I didn't ask any more questions. I just go back to work, go back to the pattern I knew, go back to making money. If that sounds familiar, you should book a call with us, because that's where I was for many, many, many years.
Yeah. And also, everybody, I did put in the link to schedule a call with one of our mentors. And then if you want to talk about annuities specifically, that's a separate conversation. I put in my personal email address. Just email me and I'll put you in touch with myself or Tess, because we're the ones that talk annuities. So just reach out to me if that's something you want to have a conversation about. Obviously, Kathleen will talk as well. I'll just put it in there. And then, Stephen, if you want to go ahead and put in the 3-day and then do a little update in 3-day for everybody.
Is Stephen out there still?
He's right there. He can. I don't know if you can hear me though.
There he is.
What's up? What's up?
So that's all the questions we have so far. So if you want to give a quick update on what we got starting tomorrow morning, if anybody is interested on that, I definitely would recommend you check out the 3-day event we got starting tomorrow. We're going to be jam-packed full of speakers, content, strategies, information. It's an amazing event. So definitely going to want to make sure you attend that, or at least go check it out.
Yeah, buy a ticket. It's $97 for the VIP. We're going to mail you a BYOB hat in the mail with it. You get all the recordings, you get the bonus sessions, you get the bonus material, the Garrick Gunderson stuff, the our family GPS stuff. You get everything. So we're hooking you up. It's less than a dinner, $97 for the ticket, and rock and roll. We're going to start with, go from A to Z, start with the mindset and rethinking banking and where your money is and the wealth killers and avoiding all that, and then get right into advanced strategies and visualizing it with the vault, asset protection, and we're going to talk a lot about implementation, taking action, and opportunities, real estate, but we'll get into the markets, the economy. So definitely a full 3 days. It's going to be a good one.
Yep.
Grab a ticket.
And you will see all of us there.
Absolutely.
during the weekend.
Yeah. All
There it
righty.
is.
So any last minute questions, everybody go ahead and put those in the chat box. Otherwise, we will let you get on your day. Don't see any other questions we had on the Wealth Wednesday either that would apply. Nope, already answered that question. All right. Well, Stephen, I don't see any of the questions. If you want to sign us off, we'll call it.
Yeah, sounds good. Appreciate everybody being here. If you guys need anything from us, give us a shout, schedule a call. You can always call 866. You guys know the number?
No, that's as much as I know.
I can't remember the last, the middle three.
There it is. 866-329-BYOB. So 866-329-2962. You can call us anytime, schedule a call, email us. We're here for you. But appreciate everybody watching. I'll see a lot of you guys on the 3-day virtual training. Starts tomorrow morning, Thursday, 10 a.m. Eastern. We'll see you there. Tess, Linus, Sipple, Fouts. Appreciate you guys. Have a great evening, and we'll see you soon.
Take care, all.
Bye.